Dear client, those who are my client on the investment space, but also dear investors, if you're an investor, especially in the stock market, this is for you as well. I'm Timbi Salutuli. I'm a professional financial planner, a certified financial planner. So this is me coming to, I wouldn't say warning, but just to give you a heads up of what we are about to face, or we're already facing, sort of like a very volatile market. I would like to use a simple word for volatile, which means a very up and down or moody market. So things are not going to be smooth in the next few months, probably the next few years. And again, this is not financial advice, but this is just me sharing information and also pointing out an engagement point. Markets are going to be very up and down. So you as an investor who's already invested in the market, you have an investment, either could be a retirement annuity, it could be a voluntary investment where you invested in unit trust, but you are in the stock market, and stock market meaning you are buying and selling shares. So you could be buying and selling shares directly through the JSE or platforms that are available there. Or you could be buying these assets through ETFs, through unit trust, through indexes. So there's a lot of them that we get in the market. So what it means is we're gonna see the values of our investment going down, sometimes going down less than what we've put in. You might see a statement coming in the next few months if you've put 100,000 saying you've got 80,000. I want to explain this phenomenon. It doesn't mean you have lost money. In the stock market, the very important things when it comes to investment is time, how long you stay in the market. It's not about timing the market, meaning when do you buy and when do you sell, but it's mostly about how long have you been in the market, because these up and downs in the long run, they correct themselves and you get what you've been aiming for. Because let's remember, when you're buying a share or you're buying a stock, you are buying the value of a company in most cases that is out there physically, a ShopRite, a bank that is physically there. So you are just buying the value of their business and how much property or profit they are making. So now the thing that we usually make, or the mistake that we usually make, is that when there is fear in the market, people are selling their investment. We also want to just sell, and that's when then you lose your money. You never lose money when you haven't sold your investment. Yes, you might get a statement that say your value of your investment is this much, but it doesn't mean you've lost money if your money is still within the investment. So I'll make a simple example. You have a house which is a 5-bedroom house. It's got 11 windows, if it's got 5 doors. So your house is in an area, and that the value of that house, because when you want to sell that house, there needs to be value attached to it. Ne? So what will happen is the value is not only determined by the number of windows and the number of doors you have and how big are your walls. Yes, that is some features that contribute towards the value of the house, but the other things that contribute towards valuing your house is where your house is, what happened on that neighborhood of your house. So when things change, you might have renovated your house, you might have put some new nice windows in your house, you might have painted it, but you find that your house value when you want to sell it is lower than what you have bought the house with. That's because it might happen that in your neighborhood there are some things that are not attractive to people who want to buy houses, in that area. So it makes people who want to buy your house fearful that, yes, I might be living in this nice house, but if I drive my car out of the yard, I'm facing crime, I'm facing a lot of shakes. So really, for me, it's not interesting to buy this beautiful house, but which is in a space that is just not attractive. So that's how also the market works. Okay, so when the economy is facing some things, or even the world economy, because this is not a South African thing that we are facing, it's mostly a world economy thing. So when things are happening that are not in favor of the markets, or not in favor of the functioning or the trading of the economy, there is high interest rates, there is high inflation, you find that people then are fearful to put more money in the economy. So they are fearful to invest more. So what then happens is that the value of most of the stocks go down. But it doesn't mean, remember the house example, when the value of a house goes down, it doesn't mean you have lost one window and now your house have 10 windows. Your house is still intact, it's still beautiful. And if you don't decide to sell at that point, you do not lose your house. Your house is still beautiful, still intact. And once the outside factors that affect the value of a house are sorted, the shakes are removed, crime is sorted, you find that the value of your house go back to its higher value as well. And then at that point, when you then decide to sell, you're now making money. So now, and the stocks, it's the same thing. So when the stocks are going down, it's because things are happening in world economy and in our economy. So the value of the stocks that we own in the investment has gone down. So I might have bought this stock with 5 rand, and then things happen in the economy, and then the value of my stock, here is my stock, it's still one, still got 4 corners. I still own the same amount of stock that I bought. If I bought these stocks, maybe 5 of them with 100 rand, that means each stock was a 20 rand. I will still own the same amount of stock if the value go down. You find that now the stock is only worth 15 rand. It doesn't mean now I have lost 5 rand if I do not sell my stock back to the market, because when you're withdrawing, it means you are selling your stock back to the market to more other investors who might take the opportunity to buy back those stocks, waiting for the right time for the stocks to go up, and then they make money. So the best thing you could do is hold on to the number of stocks that you have. You have your 5 stocks. Hold on to them. If you do not really need the money, never withdraw your investment in the time where the markets are bleeding, because this is where smart investors say when there is fear in the market, it's the right time to invest. When there is blood in the market, it's the right time to take opportunity and invest. And if you're gonna make a mistake when the markets are fearful, there is blood, and you're only seeing money going down, and you feel like I'm losing money, I, as the professional, it's my responsibility to ensure that you invested in the right space, and I've put into consideration when you do an investment that these things might happen. But sometimes the best thing you could do for your investment is to do nothing. Just sit and look. It will go down, but it will eventually correct itself, and it will go up again, and you'll make money, as we have imagine you could make money, or we have expected. So just to cut the matter short, markets are still gonna find itself in a difficult situation based on the things that are happening in our country, but also things that are happening around us in the world economy. So investment are still gonna go up and down, and you'll get statements, you'll view your investment account, and you find that you've got less value maybe than what you put in, or the value is less than the 3 months of the statement that you got, and you feel like you're losing money. let me tell you, not losing money if you're not withdrawing. Keep that money there, and then everything is going to be fine. For any further specific portfolio or personal portfolio analysis and ask me what you need to do, you'll need then to book your appointment with me, which is tembisa.luthuli@phg.co.za. Then I will look at your specific portfolio, and then I will tell you maybe we need to adjust the exposure of offshore or local or exposure, and then we structure it according to whatever you need or your goal for investing is for. But what I'm pleading for, because we usually see this a lot when markets are up and down, they're experiencing a lot of volatilities, clients then tend to, I want to withdraw my money and put it in the bank. That could be the biggest mistake you do, because you putting your money in the bank, and the interest that you will be getting in the bank might not be even beating inflation. So it means you're losing the value of your money more than you would have on the investment. All right. So definitely please do consult your financial planner if you're not my client. For those who are my clients, please do not come when you're getting your quarterly statements and you're frustrated, because this is definitely going to happen. We are aware, we are working as professionals, we are aware what will happen, and we know what actions to take. All right, peace.